What a story this is. It's EVgo. Why do I think this is an interesting story? Why, oh why, oh why, oh why? Is it an interesting story? In some ways, it starts with when I was dating a girl whose father owned petrol stations. And I was having a conversation with him one day about the price of oil because it was quite historic then, in it around about the times of the global financial crash, and the price of then the petrol at the pumps was high too. Talking about just historic oil prices, really, essentially. And thinking at the time, like a good kind of acolyte of Rockefeller or something like that might, this black gold stuff, you just got to keep on pumping it out the ground and selling it because people are always going to need it and want it. And you make money no matter what the price is, which is great. What it seemed like. And then they were pretty loaded. They had plenty of money, and it seemed to me that people stopping their cars off at various petrol stations, the one that they owned, was a good way to make money, to own petrol stations, gas stations, what you call them over there in the States. Well, the world is kind of changing, and there's a new story in town. What is the question? Well, if you were to own the future gas stations, what would they be? Well, they would be petrol. They wouldn't be petrol. They'd be electric charging points. Maybe, right? That's a maybe bet. Maybe all the future cars have got solar panels on the roof and just go around making Jetson happy noises, bloop, 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 and makes the environment better by being driven. How about that? That's maybe the future. Nobody needs to charge them ever because they charge themselves. Okay, I'm not talking about that future. I'm talking about the next sort of 10, 20 years. And if you thought like, oh, what would be a good bet? Would it be to buy a petrol station? I wish I owned a petrol station, or did I wish I owned a charging place? Well, what's the company that's got the most of them in America then? And this would be EVgo. This is the biggest player in the American markets. EVgo, that's its name. And kind of think like, well, is this a cheap stock price for this company? And let me just check and see. Put it on the weekly time frame and scroll back and see. Oh my goodness, this is like serious lows. That's the weekly time frame. Here's a monthly time frame. You can see, all right, okay, so this is like the lowest it's ever been. And makes me think then, okay, so what's wrong with this company? Why is it so cheap right now? And if we wanted to, we could go and analyze certain things like the earnings. Okay, so they did have earnings recently, and they were, well, as you can see, I suppose, from the icon color and the notes here, they were not what analysts had hoped for. Their earnings were slightly lower by 10% what they'd predicted, and the revenue was slightly higher than what they'd predicted. And we can see actually some note here, charging revenue up 19% year over year, but net loss widened and non-charging revenue fell sharply. That's the notes. So it's like I'm trying to understand this company because like if I think to myself, I would like to do, benefit from people needing to refuel their automobiles. And if I thought maybe instead of gas right now, I was looking to try and get into like the futuristic one, maybe when it's like at ground floor, to try and get as much of something as I could. What would it be? Will it be ExxonMobil and Shell, or would it be something like this company? Well, okay, it's like this one. But they see then its stock prices at all-time lows. I want to understand the story more. And the story is telling me that their earnings aren't what people had wanted to see, so that's not good. And while their charging revenue is up 19% year over year, their net loss widened and non-charging revenue fell sharply. You'd be thinking, okay, what's the problem? Like, that's the problem. And what else? And if I did some research into this, I would discover that they've been doing a lot of Capex, like loads of Capex. And it reminds me of the Oracle story. You know, you're building out infrastructure. Well, they build out a new charging place. People don't turn up immediately on day one because they don't even know it exists. And then eventually gets added to their maps. They turn up. And then they start adding it to their routine in their own life. And then suddenly, after a few months, a charging station is actually making money for the company. And then, you know, there's a lead time between when you build one and when it starts making money. And if you keep building more and more and more, then you've got like all this debt that you're trying to accumulate, you are accumulating, and you've not got the earnings yet because it's not built up. So there's this disconnect, and you're having to like take faith that it will happen. Build them and they will come. So on that build it and they will come thing, are they able to address all the market? Well, up until recently, the answer to that was no. They were addressing like half the market. They're still the biggest, but they're addressing half the market because they couldn't charge Teslas, like which is the world's most popular car, sort of in a way, manner of speaking. So if you look at like sales of individual models and so on, maybe you could say this was them missing out on a massive part of the market. So is that changing? And as a result of recent deals with Tesla, it is changing. They're starting to build out these supercharging stations at their different stations. So I'm thinking, okay, cool, we've got a big addressable market there. Like the other half of the market suddenly is opening up to them. Will that be able to retrofit on quickly? Well, not really, not super quickly, but over time it sure as heck will. And they're doing it as they grow. They've got a deal with Tesla to start making or taking over some of the stations for them. They've got a deal with Tesla basically, which is interesting. And it's like making me think, okay, so actually maybe, you know, there's some things here are okay for them. If I look in the more detail of this, I'd find out about the non-charging revenue side of things and ask, what is that? And they've got this network they call Extend, EXTND. Well, no, that'd be Extendi, so not that, but Extend. And they build stations for like other folks that need them because they're experts at making these charging stalls, whatever. And that is revenue that's dropped because they were making lots in Q1 or Q4 of last year, but then not so much in Q2. So, you know, the earnings show that's not gone so well. And then they've got more billing for that coming in towards the end of the year. So there's a kind of a key thing here. If their guidance is going to meet the end of year, full year guidance is still going to be what they said it was, and they've maintained that throughout the first half of the year. But they've seen their revenues falling compared to what they'd hoped for and their earnings dropping because they're doing all this capex, then will that story start to turn around? Well, if they're telling the truth, you know, essentially about things like their Tesla deal and their growth in their charging network and how they got this stack towards the end of the year in terms of revenue, then yeah, that should turn around. What's the future problem though beyond that? If I looked a bit further, what would I find? Well, I would, because I've done the research, right? So kind of like, and you should do your own research so I can summarize it for you. If I look a bit deeper into the story, I would find that the revenue that they said that they're going to get from that side of the business going into 2027, 28 periods is going to drop down a good chunk from what it was, and it's not going to be as big a part of the revenue source anymore. Then you think, okay, so where's the future of the growth of the company? And it comes from this massive build out of their network and the capex they're spending. And it's like, okay, so we know that the company is a low price compared to its history. What about the debt then? I'd ask about the debt. Who's giving them the debt? Where is it coming from? And EVgo or EVgo or whatever you call them have got this great benefit that they like I seriously actually I'm not 100% sure if it's EVgo or EVgo or EVgo EVgo is that it? I don't know, whatever. Half of their debt, like 500 million that they can draw, comes from the US government. So that's a pretty good one. They're a pretty good debtor, creditor to have, the US government, in like all this sort of subsidy stuff. That's much better than having it with the bank. So I think it's an interesting company. I think it's an interesting story that is part of kind of like a turnaround company, but at the same time, it's like the biggest network in America, seeing massive growth, like 20% growth year over year, as charging stations get faster. So they're putting more throughput through the station, then they've got more downtime. So some of the statistics look a bit weird because you could be making more money, you're having more customers every day, but less time actually spent charging vehicles. That just means more vehicles can come in. It's more headroom for growth. It's like, it's all part of building out a network. Then you think about, well, EV sales have been dropping. And it's like, well, no, the growth, it's like disinflation. It's not that EV sales have been dropping. Nobody's buying no EVs anymore. Actually, second-hand EVs have been shown to have a much longer lifespan than people predicted. The quality of the cars remains high. They've got different use cases, like one for range that's new, and one that's kind of a bit of a runabout or for your kids and so on. People who are buying secondhand are buying a lot of EVs because the prices is like cheap in a sense, as people, don't cost in properly necessarily, battery lifespan and so on. So there's like this kind of good vibe in the EV market where it's still growing, and a lot of subsidies have been removed kind of globally for electric vehicles, but it's still growing. There's still more sales happening. It's kind of a question of how many sales are happening versus how many electric vehicles are being scrapped, and not an awful lot of them are being scrapped really overall quite yet. The numbers aren't lining, so the market is definitely still always growing. And that means that there's more and more demand for these services, these stations. So I think it's an interesting story, right? It's an interesting story. They're at a point then when it would be good to see how markets respond to what would maybe be a healthier looking numbers in the latter half of the year. So what targets would I have if there was a turnaround? And I am looking up towards numbers like 260, 270, and that's $1 up from where we are now. So this is a thing which could be potentially representing $1 a share trade. It seems like a fairly, from a macro kind of picture time wise, something that might be starting to offer really good value for a trade just back to, I don't know, less than really parity for what it really kind of what it's worth. I wonder what it truly is worth. But I know that in the future, this could be worth an awful lot if the profitability from the company operations actually starts to be able to outstrip the cost of the debt and everything else. Then that's a big inflection point. So that's what investors are watching for, a big specific milestone late in the year, the exact moment that the charging gross profit finally covers the company overhead. Another thing about the valuation is trading down the two in this range. Stocks priced for disappointment, that leaves little room for error, right? But like plenty of disappointment on the top side. Could it push lower? Could it push lower? Every time it's pushed lower, the question would have been asked that, the answer has to be yes, it can push lower. You might want to wait for things like for it to prove itself before wanting to invest long term. But traders, I think, could be looking at this one with a bit of an eye on, price action in these zones. Wall Street's not like fully walked away from this one. Major shops like JP Morgan are maintaining overweight ratings on the stock. So pitching current lows as heavy discounts is kind of coming from the word on the street as well. But you want to look into analyst ratings yourself to see, because some still maintain it as a sell. One I think does. EVgo isn't a play where the balance sheet sits. It's like right now, this stock price is perhaps reflective of the balance sheet right now. The value on this one comes on whether or not you think that there's going to really turn around things for the end of the quarter and start being valued on its balance sheet then, at which point you'd be selling it to those people who'd be buying it off you thinking, oh yes, this is good value at 220 to 260, because it would look like that then if things go to plan. You'd be offloading $1 per share profits. This is one that's an interesting one.